Hello, this is Ravi again from the Nifty BN channel, and today we'll learn about the option strategy named caller. Previously, in our video on the covered call option strategy, the link to which has been provided in the description of this video, we discussed how the strategy offers no protection to the downside. By adding one more leg to the covered call option strategy, that is, by buying a protective put, usually an out of the money put, we would be able to cap the losses in case the underlying falls sharply. A caller option strategy is actually a combination of two strategies, a covered call and a protective put. Now let us look at the setup. A caller consists of owning a stock or futures contract, buying a put to protect the downside, and selling a call to pay for the put. The call and put have the same expiration, but sometimes a longer dated, further out in time put option is preferred. The collar is one of the most used earning strategies because of its defined risk to the downside and limited reward to the upside. As earnings announcements and government economic reports are usually met with significant price reactions when the news is released, a strategy with a limited risk to the downside is preferred. And here is where the collar scores over the other strategies. It is also used to protect gains when the price of the underlying is approaching strong support and resistance zones. An example of how a collar can be set up on State Bank of India is given below. Buy one lot of futures at 194.85, sell one lot of 210 call at 13.05, buy one lot of 170 put at 8.55. All of these have the same May 28 expiry. The current spot price of SBI is 192.90. Now let's look at the risk graph. It clearly shows the profit capped at rupees 58,950 and the loss capped at rupees 61,050. The break-even point at expiry is at 190.35. Let's know how to arrive at these numbers. Net premium. Net premium is nothing but the difference between the call and the put premium, which in our case is 4.5. Break-even point. Break-even point is equal to futures price minus net premium, which is 190.35. Maximum profit at expiry. Strike price of short call minus futures price plus net premium into lot size. The lot size of SBI is 3000. So by plugging in these numbers, we arrive at a value of 58,950. Maximum loss at expiry. Futures price minus strike price of long put minus net premium into lot size. Here we arrive at a number 61,050. In case we wish to deploy this strategy on an existing stock in our portfolio, we need to replace the futures price with the initial cost of the stock. Let's look at a few other takeaways. A collar is a bullish strategy and has a similar risk-reward profile as a bull call spread. A vertical spread strategy in which a call option with a lower strike price is bought and another call option with a higher strike price is sold. One disadvantage of a collar though over the bull call spread is you need to buy the underlying, whether stock or futures, at the outset, which can be expensive. We'll talk more about the spread strategies in a future video. If you are bearish on the underlying, you can opt for a short collar instead, that is, sell to open futures contract, buy to open an OTM call for protection, and sell to open an OTM put to generate income. However, we cannot replace the futures contract with a stock position in the short collar, as a positional short position on the stocks is not allowed in the Indian market. Also, no adjustments have been suggested to the collar as we consider it a set and forget strategy. Thank you for watching. Please post any questions you have on this video in the comment section.